I like excitement and surprises, but when the Fed got more and more transparent, would there be any reason to get this transparent if they were going to telegraph what they're doing and then do 50 or 0? I mean, what would you be absolutely shocked if they did something other than what's expected at 25? I would be.
Well, I think the key question is what markets are pricing in, and that's really the key question for the Fed.
And do they adhere to what the markets are pricing in? Wouldn't they be loath to do something that the markets weren't expecting?
Well, I think in the current environment, if they don't deliver on some form of accommodation, some form of easing, then they're going to risk tightening financial conditions. That's what we saw in the fourth quarter of last year and the first quarter of this year, where miscommunication about the Fed's intention led to a significant tightening of financial conditions, which went exactly against what the Fed was trying to do. So in this current environment, where markets are pricing in about 100 basis points of rate cuts over the next 18 months, I think the Fed has to deliver some form of easing. Unless it does that, the rest of the central banks around the world are easing, and you end up with a dollar that's stronger, and you end up with financial conditions that are tighter. So it doesn't really have a choice at this point. And if you look at the economic justifications, the economy is doing relatively well today. But if you look down 12 months down the road, 18 months down the road, you have a global economy that's weakening, you have domestic momentum that's cooling, and you have inflation that continues to undershoot the 2% target.
Can I just throw a little wrench into the whole thing here, which is that two of the Fed presidents, George and Rosengren, are not on board with rate cuts. I don't know how much that matters. Could it be possible to have two dissents at that to any rate cut at all?
Anyone at 50?
I'm looking at that list here.
We could cancel out the zeros with the 50.
I interviewed Evans last week, and he sounded like he would not oppose a 50.
What about Bullard?
Bullard has been a 25. Bullard's been a 25. I'm trying to look at here for support for 50. Only John Williams, the first John Williams, as President Trump pointed out, would have supported a 50, not the second John Williams.
But I think in the current stance of things, if you have this delivery of 25 basis points, you're essentially delivering part of what markets are expecting, and you're signaling that there may be further cuts in the fall. And I think that's perhaps the right approach today, is that you're not sure what's going to happen in terms of trade policy. You're not sure what's going to happen in terms of fiscal policy with all the issues surrounding a potential government shutdown, a debt ceiling debacle. So let's just cut now, signal to markets that there is the possibility of further rate cuts coming down the road, and you're essentially positioning yourself in a much more accommodative stance going into 2020.
One of the other things that a quarter-point cut would do, and I think a lot of people are focusing on this, not so much the economic conditions, but just the yield curve and how conspicuous it is that 3-month Treasury bills are above 2% in yield. Almost no other bonds in the world are above 2%. If you get down to down 25% on the short end, presumably, we get a re-steepening of the yield curve. Do you think so?
Yeah, I mean, that's what we're trying to get to. We're trying to get to an environment in which the growth outlook is improving, not deteriorating. And if you look still to the next 18 months, you're looking at a growth environment that is weakening. And I think we cannot forget the importance of the dollar in this whole debate, because we have had a series of central banks around the world. In Asia last week, a number of central banks ease monetary policy. The ECB is on track to ease monetary policy. If the Fed does not deliver upon the expected easing of financial conditions, then you're going to get a much stronger dollar.
I tell my kids, Gregory, just because everybody's drinking doesn't mean you have to also.
That's right. But if you take the Fed's new mantra of 1 ounce of prevention is worth a pound of cure, then that's the type of direction they want to head into. Avoid a surging dollar.
You say weakening.
Yep.
Is that the same as weak? When I look at the data, if you were looking at data just what we know now, what would you say backs up the idea of any rate cut whatsoever?
I think if you look at the outlook, 18 months down the road, you have an economy that's going from a 3% growth environment to an environment where it's likely to grow under potential. That's really what we're facing.
In other words, below 1.8.
Below our estimate is 1.8, yes.
Okay, so of potential.
Yes.
So the data right now, our CNBC rapid update, of which you are a contributor, is 1.8. We did 3.1 in the first half. So you're running right about or even above potential for the first half of the year. The job market is strong. Consumer is strong through retail. You have this decline in capex that some say is even bottoming out.
The risk, in my opinion, is that you get a negative shock, whether it's from trade policy, from government policy, that hits confidence, that hits stock markets, that leads to surging volatility, that in turn exacerbates this slowdown. It's very hard for economic actors to handle this type of change in momentum. 2018 was all about accelerating. 2019 is about decelerating. And decelerating is much harder from an economic perspective than when you're accelerating. So from a Fed perspective, you might as well do some of the easing today and avoid having to do more tomorrow.
I would only throw back at you the following.
Yes.
The Fed had a 2% GDP forecast already in its outlook, along with a 2.75% to 3% Fed funds rate. So now what they're doing is they see the same growth rate that they pretty much predicted, but now they're seeing a much lower.
But remember, not so long ago, they had a major inconsistency, and they still have to some extent, that the unemployment rate was rising very fast in their long-term forecast, despite the economy stabilizing at 2%. That was implying a recession. So their forecast was not necessarily the best way to look at their
You just made more of an argument for them not to do anything because the unemployment rate's even lower than they expected.
Yes, but again,
so
if you look down,
are they data dependent anymore?
I think they are.
What
I think
data?
They are. But that's the problem. They don't know what
Sovereign
data.
yields.
They don't know what's going to happen on trade policy.
Everywhere
they
else.
don't know what's going to happen on
They
fiscal
live-
policy.
it's all relative
And
now.
they don't really know what's going to happen on the global
We're the
front
highest
either.
on the planet right now, and that makes no sense, especially when we're trying to.
Not when you have the massive budget deficits we have. That's what creates
No one's even talking about it. Look, I hope in your next debate you bring that up. It's coming up soon.
No, it's got nothing to do with it being good or bad. It's got to do with the need for us to issue debt.
It was on last week that was not that worried. I tried to get the $22 trillion to be a big concern.
Who was it?
Can't remember. But someone that I
I
respect.
don't think it's a big concern
not-
for
I'm
an
not
economy
worried.
like the U.S.,
You don't.
honestly.
Yeah.
The current
You don't think
low
It
income-
creates a need to import a lot of capital. That's really the
Yeah.
issue.